Good afternoon, everyone, and welcome to the post-trading day. Today we have a wonderful presentation for you here at TradeStation, and we're very excited about it. I'm Don Prattle, the Director of Trader Development here at TradeStation, and today we welcome Mr. Steve Bigalow of the Candlestick Forum. And Steve's presentation today is going to be aimed right in his sweet spot, a commentary that he's lent to many traders around the trading world for a long time. Steve has over 25 years of investment experience, including 8 years as a stockbroker with major Wall Street firms like Kidder Peabody, Cowan and Company, and Oppenheimer and Company. Then he became a commodity trader, and he overlapped with 12 years of real estate investing. He holds a business and economic degree from Cornell University, and he's lectured both there and at many other private educational investment functions over the past couple of decades. So as I said, today we're going to talk about understanding candlestick patterns in major moving averages. Our presentation is for educational purposes only, and all the symbols and all the trading ideas that we discuss here are for demonstration purposes. They are not recommendations. This presentation is not an offer or a solicitation of any kind any place where a TradeStation affiliate has not authorized or is not authorized to do business, including but not limited to Hong Kong and Japan. Remember that active trading is not suitable for everyone. It may not be suitable for you. Options trading carries a high degree of risk and may not be suitable for all traders. In the chat panel, I posted a couple of pieces of disclosure information regarding the risks of and characteristics of some of the asset classes that we cover here at TradeStation, and I urge you to take a look at that information at your convenience. If you click those links, you can open those documents in a separate browser window. The question that always comes up right about now is, are we recording, and when will the recording be available? We are recording, as we do many of our TradeStation events here. And so that recording from today's presentation will be available sometime tomorrow in our TradeStation YouTube channel or in TradeStation Video Station if you're a TradeStation user. I've posted the link to the YouTube channel also in the chat panel. Now, not all the chart illustrations that are going to be displayed in this presentation are TradeStations. Many of them belong to Steve Bigalow, and they're not illustrations of our tools. We do provide the same analytical and non-analytical tools that Steve's going to be talking about. And if you need to review the TradeStation tools, this link is a link to our YouTube page to talk about our analysis available, the charts available, and the tools available on the TradeStation YouTube page. So, without further ado, let's welcome Steve Bigalow to TradeStation to help us discuss or understand today candlestick pattern presentation. Let's have a nice welcome to Steve Bigalow.
All right, thank you, Don. I guess the first thing I better figure out is, can everybody see my cursor on the screen? That may be the why we don't use slides.
All right, so what you should do, Steve, up here where there's a pencil, you see the drawing tool in the panel there? So give that a click.
Okay.
And then choose your weapon there. I think that laser pointer, the little red document or little red object there, will be your pointer.
I've done an arrow. Can you see the arrow?
It hasn't happened yet.
Let's try the pencil.
Well, the pencil is going to allow you to draw. So click the pencil and then make the choice. Maybe because I had it open.
Okay. All right. Is there an arrow there?
Not yet, sir.
Red dot.
Yeah, there you go.
The red dot.
Yep. Follow
Okay,
the bouncing ball.
All right. Okay, well, thank you, and welcome everybody. I guess the first question I usually ask, so I know how fast or slow to go, is how many people have seen my candlestick presentations before? Obviously, Y for yes, N for no. Okay, very few. Okay, all right. That'll let me know how descriptive I need to get on each chart. I started, as a matter of fact, my investment career has been updated. I'm probably pretty close to 40 some odd years of investing. Um, I came across candlesticks by accident back in the late 80s, I think. And tried to learn everything possible I could about candlesticks because when somebody laid it on my desk, I figured anything as sophisticated sounding as candlesticks wasn't worth the time and effort. And then finally, he kept badgering me because he knew I'd been a stockbroker. So when I looked at it, I said, man, this makes sense. And the more I looked at it, the more sense it made. So I wanted to learn everything because back then, I didn't have anybody to go to get a second opinion on what I was learning. I tell people back then the only time I could get a second opinion was I'd go to the doctor. And I'd say, what's wrong with me? He goes, you're fat. And so I'd say, I think I want a second opinion. He goes, all right, you're ugly too. So I had to learn everything possible I could of candlesticks. Whoops, Don, does that go? So what I discovered was out of the 50 or 60 candlestick signals, there's only 12 that you have to learn. These are what we call the 12 major signals. And the reason if you learn those, well, most of the other ones don't occur often enough to spend mental time and energy try to learn them. Oh, so before we get started, if you have questions, feel free to ask them as we go through. I'll try not to keep you here all night long, but we'll get as much information as possible. But don't be afraid to ask questions. Um, so I discovered these 12 major signals always occurred most of the time, like probably 98% of the time at the reversals. So the Japanese rice traders did two things for us. Not only did they show us where to recognize these signals, but they also described what the investor psychology was that created the signals. So if you learn these 12 major signals, those are I guess, the building blocks. I always tell people prices do not move based upon fundamentals. Prices move based upon the perception of fundamentals. And candlestick graphics are merely the graphic depiction of what's going on in investor sentiment. So this is how a lot of people use the uh, TradeStation charts, except I'm hard of seeing. So I use it backwards. I usually put on a white background to make my analysis. Now, the charts on TradeStation are very good and clear, no matter what you're looking at. But I add a few things that make it much more clear as to what things are doing. So we can improve the probabilities by adding moving averages to our charts. Now, not only are we going to have the major moving averages, but we also have what we call the T-line, which is the 8 exponential moving average. And there's a very simple concept of the T-line. It basically works extremely well on the basis that if you see a candlestick buy signal and a close above the T-line, you can stay long until you see a candlestick sell signal and a close back below the T-line. So the most important concept about candlesticks is the graphics of candlesticks are simply telling you what's going on in investor sentiment. If they open at the low end and close above where they open, it creates a white candle. If it opens higher and closes lower, it creates a dark candle. Doesn't necessarily mean that the price is up or down on the day. It just tells you what's happening after they've opened and closed the session. So again, the simple T-line rule is if you see a candlestick buy signal or close above the T-line, you can stay long until you see a candlestick sell signal to close below the T line, with a caveat. The further away you move from the T line, the higher the probability it's going to come back and test it. So the more you start moving away from the T line, if you start seeing candlestick sell signals, the probabilities are that much greater that it's time to close out the position, because it's probably going to come back and test the T line. Now, when you put those two in combination, the T line acts like a natural, or basically a Fibonacci type number, where it's a natural support and resistance to human nature. So when you add the graphics of candlesticks, which is the graphic depiction of human nature, and the T line, which is a natural support and resistance level of human nature, you now have a very powerful combination to keep you in positions until it's the exact time to sell. Works just as well on the downside. If you see a candlestick sell signal and a close below the T line, you can stay short until you see a candlestick buy signal and a close back up above the T line. So this makes it easy that if you're in a trend, you can see there might be some selling. When is the selling over, or when is the uptrend over? When you see that sell signal and a close below the T line. So this is not rocket science. This is the graphic depiction of what happens in human nature time after time. And the Japanese race traders have perfected it over the last 400 years. And it works just as well today as it did 400 years ago and 400 years from now, because human nature, when it comes to investing, is the same over and over. Marie, all you do is you put the 8 exponential moving average on your chart, just like you would the 50 simple moving average. I forgot to say, on our charts, we're going to be talking about the moving averages that improve our probabilities. The red line is the 200-day simple moving average. The blue line is the 50-day simple moving average. And this gray line is the 20-day simple moving average. The reason we have those on our charts is because every major money manager around the world uses those moving averages to make their decisions about their portfolio. The advantage we have with the graphics, the candlesticks, is we can see exactly what those decisions are at those support and resistance levels. So candlestick signals have truisms. You know you're in an uptrend until you see a sell signal and a close back below the T line. If you add that to the fact that that occurred smack dab on the 50-day moving average with your stochastics in the overbought condition. Now I use stochastics of 1233. Most of my trades are swing trades, meaning they're going to last anywhere from 2 to 10 trading days. And there was nothing more sophisticated than going back through charts probably 40 years ago, spending one night saying, all right, what stochastics coincide with the peak and the valley of a price move? 1233 has worked extremely well for me over the last 40 some odd years. And again, the truism of the further away you move from the T line, the higher the probability it's going to come back and test it. So these are dojis up here. These are the most well-known of the candlestick signals. And a doji merely is where they open and close right about at the same level, which illustrates that there's indecision between the bulls and the bears. Then we have a very simple doji rule. The price is usually going to move in the direction of how they open it after a doji. So if we're up here in the overbought condition, we've moved that far away from the T line, and the next day they open it lower, the probabilities are extremely strong that you want to close out the position, because where's your next likely target? Back down to the T line. We can always buy back on one of our patterns, which we call a J hook, where they bounce it back up. But we don't know whether when it gets here it's going to bounce back up or whether it's going to go down. So why risk it? The probabilities say close out the position and then wait for the next buy signal. So this also makes analyzing anything that you want to trade, whether it's stocks, bonds, currencies, futures, anything that has fear and greed. Yes, 1233 slow stochastics. Anything that has fear is going to be very well illustrated by candlestick signals. So it makes common sense trend analysis or when you're analyzing a market. Right here we have a strong buy signal. This is what we call a bullish flutter kicker. Up here we've got that shooting star doji, and then look how far away we are from the T-line. That tells us there's probably profit taking. We can also see what happens at the top and the bottom of this wedge formation based upon the candlestick signals. So we can much more accurately analyze what the overall market trend is doing, because that puts us into situations of whether we want to be predominantly long or short. So when candlestick signals are accumulated, they also represent patterns. This is what we call a fry pan bottom. It looks like a fry pan bottom. And where is the breakout? Right here where the fry pan started. And this is one of our strong signals. This is what we call a left-right combo, which is a doji. You can see the little doji right here, which represents indecision, followed by a big bullish engulfing signal. A bullish engulfing signal engulfs the body of the previous day. Now, in Japanese candlestick analysis, the body is the important factor. That's why the Japanese boxed in the open and the close, because those are the two most important decisions each day. Where do they open it, and where do they close it? Those are the important decisions. Is what it creates all the candlestick signals and illustrate what's happening in investor sentiment. So if I see something like this setting up, I may not buy here, but I'll start buying here. Now, there's two criteria. If you see a candlestick buy signal, you want to see it in the oversold condition, because the Japanese rice traders say logically, if you see a candlestick buy signal in oversold condition, probably there's a reversal. If you see a candlestick buy signal in the overbought condition, it doesn't mean very much. On the other hand, if you see a candlestick sell signal in the overbought condition, that's much more relevant than seeing a candlestick sell signal in the oversold area. So you're looking for the signals where a buy signal, obviously where you want to be buying at the bottom. So the other side of that coin is, if we're buying the signals in the oversold area, or the buy signals, on a pattern breakout, usually your stochastics are already going to be in the overbought condition, because that's the buildup of investor sentiment, and you're watching to see where it's going to start breaking out. So this is what we're looking for. Where do we think we're going to be looking for a breakout? Right about where the fry pan bottom starts. And this is what we call your best friend. Everybody asks, what are the strongest of the signals? Well, they're all pretty strong. That's why we've narrowed it down to the 12 major signals. But there are combinations of signals, like the doji followed by a gap up. We call that your best friend for two reasons. One, because the probabilities that you're going to be in a strong uptrend the probability is pretty strong you're going to be in an uptrend. And number two, the uptrend is probably going to be extremely strong uptrend. Same scenario on the bearish side. The opposite of a fry pan bottom is what we call a dumpling top. And what do we expect coming out of a dumpling top? The same scenario we expect coming out of a fry pan bottom, where on a fry pan bottom, we expect an extremely strong price move. On the dumpling top, we expect an extremely strong downward trend. So when we start seeing this set up, notice where it was time to start going short on this. Every time they did a sell signal and closed back below the T line, because that puts us in situations where the probabilities are pretty strong that this is the results that we're going to be expecting. Another pattern is what we call the J-hook pattern. Very simple. There's our best friend, starts a strong uptrend. There's our sell signal. Kind of your bearish left-right combo. How can I figure out the T-line? Very simple. It's the 8 exponential moving average. You put it on your charts just like you would the 50-day simple moving average. When you add a moving average to your chart, it's going to ask you what day, and you put in 8, and it's going to ask you whether it's a simple or a exponential. So a J-hook pattern is very simple. comes up, profit taking, pulls back. And what's the psychology? Psychology is that usually after every strong price move, there's profit taking. Now, back before candlesticks came along and I got out here and it turned around and went back up, I'm thinking, they're not going to trick me. They're not going to get me out and then get me back in so they can take it away from me. Now I know that if this is wave one and I can see a buy signal, this is what we call a kicker signal right in here, which I've got covered up, but that's one of the strongest bullish signals. But I know that this is my likely target, mainly because wave one and wave three are going to be approximately the same. So if you're a stock trader, it makes you look to see, all right, is this worthwhile? Is this a big enough percentage? Now, the benefit of candlestick analysis is we can look at a chart and see what our next pattern is. If this is a 4% move on this chart, we've got another chart where that move is a 40% move. Obviously, we want to go after the 40% move. It may not be worth our while to put our money into something that's only going to be moving 4% when we can find something that's going to move much greater. So wave one after wave two is going to be equivalent to wave three. Either a good option, a stock trade, or if I'm an option trader, I might be buying one set of calls and selling another one as a spread, getting a little bit better leverage and risk reward factor. So anytime, even if I've missed this move, and I see there's our left right combo, and this is what we call convergence analysis. Notice where the left right combo occurred. Stochastics in the oversold area, and it occurred smack dab on the 50. Now, that's not a coincidence. If you're an institutional buyer and you just went in and told your investment committees that you want to buy this stock and it's drifting back, where do you think you're going to wait to see if it's going to act as support? We can see exactly what's happening at those support levels. So I often get asked, how many days does it take for you to confirm that you're in an uptrend? Because there's a lot of technical trading methods that use 2 days, 5 days, 3%, 8%, something to tell you the uptrend's in progress. The answer for us is 0. If this is our left-right combo, what are we looking for the next day? We're looking for buyers to step in because that is our signal. So if it opens positive, we want to be buying. If it gaps up, what's that tell us about the investor sentiment? Well, they had a strong reversal and now they're gapping it up. That tells you exactly what you want to know, that they're not only buying, but they're buying with great force. And that's exactly where we want to be buying. This kind of cuts out your emotions as far as getting into a position, because if we know the probabilities are extremely strong, if we see a bullish reversal signal smack dab off a support level and they gap it up, we can be buying immediately to take advantage of that next profitable move. So anytime we take profits and we see that it's not going below the T line, it's curving back up, we can be buying again. I don't mind selling here and buying here, because that right there, if you cut off the chart, you didn't know whether they were bringing it back down here. But I'm buying here, tells me I've got good probabilities they're heading up again. So if this is a 10-point move, I don't mind getting only 8 points of it, knowing that I got out when it was time to get out, got back in when it was time to get back in. I would rather miss out on 10 points and just take the 8 points that have an extremely high probability of a correct trade ratio, which tells me that that if I can get a high correct trade ratio, my compounding effect will be much more huge than trying to buy or hold the whole trend. Now, if we know what our patterns look like, we've got a bobble pattern that even is more definable, that's the right word, than a J-hook pattern. Bobble is what hits a resistance level, then pulls back to the T-line. So the benefit we have is we can see it hit a resistance level. There's our doji, and what's our simple rule of the doji? It's going to move in the direction of how they open it after a doji. So if they open it lower, what'd that tell me about my resistance level? It's acting as a resistance, close out the position. We can be buying back here because there's that J-hook pattern or the bobble, because notice what happened right as it hit the T line. Another buy signal told us we could be buying, because if you took out the 200, what do you have here? You basically have a J-hook pattern. The bobble is just a much more defined, uh, showing you where it resisted and where it was supporting. The T line acts as support, tells you to get out and get back in when it comes back up through the second time. So if I'm buying Bidu right here, and I can see that it did a bearish engulfing signal right at a major resistance level with stochastics in the overbought area, it tells me get out of the position. Then this tells me to get right back in the position, because again, if you took out the 200-day resistance level, you'd essentially have a J-hook pattern telling you your next wave to the upside is starting. So again, this is not rocket science. This is just using the graphics of what happens in human nature time after time. There's that doji with a lower open right at the 50. There's your T line. There's our morning star type signal, which is another major signal. Now they're going back up through. It's time to be buying back. There's a bobble. Time to take profits. Could never close below the T line. Buying back, because if you took out the 50, what do we have? Probably wave one going into wave three. Failure. And the reason we use the bobble so exact is you can see exactly at the levels that everybody else is taking profits. So you're closing out your position, and then you can see what happens on that breakout, bobble breakout. You're right back into the position. So if I see something like this and see this closing right here, this was the transportation index. If it opened positive, what's that telling me? I've got a bobble breakout that the transportation index is still moving higher, which is usually a good indication they're not selling off the market. More than likely, they're going to be moving the markets higher. And that's exactly what happened right here, is when it broke out, had an uptrend until when? Until we had a sell signal and a close back below the T line. Now, we also have what we call the T line crunch, which also is affected by the moving averages. And it's the difference between a T line crunch and a bobble is that it doesn't have to come up and hit and pull back. You can see how the T line keeps crunching this right up through the resistance level. So if you make this a little bit bigger, we're watching and seeing there's no selling. Now they've closed it up above what that trend channel resistance level was. That pretty much told us we continue to hold our long positions. There's still more upside. So the T-line crunch doesn't have to come up in here and hit. All you have to do is have the T-line keep crunching the price up through the resistance level, which tells you there's going to be more upside. And this is what we call a doji sandwich. Notice how the T-line brought you right up to the 50, and it did a doji on the 50. Again, the doji has a very relevant indication that they're going to move it in the direction of how they open it after a doji. So if they had opened this lower, we were taking profits. The fact that they open it positive after a doji told us that this candle right here is probably going to have the same magnitude move as right here, or vice versa. This magnitude move right here is going to be the same as this right here, with the doji sandwiched in between. So if it opens positive, our first piece of evidence is they're probably going to trade it positive. And the second piece of evidence is that this candle and this candle are going to be about the same. That tells me the 50 is not going to be acting as resistance anymore. There's our doji sandwich. And there's an expectation of a doji sandwich, that there's going to be more upside. So as you can see, this whole uptrend had one significant factor. They could never close it below the T-line. So when they went through the 50 T-line crunch, that told us we had a lot more upside. So that's what I illustrate on this chart. But you can always look at the chart and say, all right, when was it time to buy? Well, the Japanese rice traders make it very simple. The graphics of candlesticks show when most people buy. They buy exuberantly at the top, and they usually panic sell at the bottom. And that was usually me before candlesticks came along. And I was even a stockbroker uh, for eight years. But I would always ask myself rhetorically, how come every time I tell people to buy, the stock turns right around and goes the other way? Or how come every time I get people out of a position, it turns right around and starts heading back up? Candlestick signals show you, there's our morning star signal. When it's time to buy, there's our bearish harami. Now, what was the alert? First of all, we started seeing gap ups in the overbought condition. That illustrates exuberance. Then we saw our bearish harami. That's an inside day. And as soon as it opened lower the next day, we're taking profits. Where is it going to come back to? Probably at least back to the T line. Can you clarify regarding what you said earlier about the doji as an indicator of direction or something of that nature? Does that show true here? Yes, pretty much that they're going to move in the direction of how they open after a doji. And then again, there's our doji up here, harami. If it opens lower, what are all the indications telling us that it's time to take profits? One, look how far away we are from the T line. Two, look where they started gapping up in the overbought condition. That shows you exuberance is coming in. And three, we have a doji harami. A harami is an inside day where they open and close inside the previous day's body. And then four, what's our simple doji rule? It's going to move in the direction how they open it after a doji. So if they open it and start trading down, that tells us take profits because where are they going to move it back to? Back to the T line. So very simple rule. If you see a doji, especially in the oversold area, and they start trading positive, that tells you that the reversal has occurred. All right, so that was the bobble and the T-line crunch. So those are just some very simple techniques to use using candlestick signals in conjunction with your moving averages. You can also use it in your trend analysis and your trend channel and for profit taking. So why is a trend analysis important? Well, obviously, if you think there's a market uptrend, you want to be trading long. If you think the market's heading lower, you want to be predominantly short. So what signifies the market? Well, the Dow, the Nasdaq, and the S&P 500. A lot of people say, well, why the heck do you use the Dow? There's only 30 stocks in there. That's because that's where the big money is watching, and that's the psychology of the big money. What time frame? The nice thing about candlestick analysis, Roderick, is candlestick signals. I forgot to even tell you the definition of a candlestick signal. Candlestick signal is the cumulative knowledge of everybody buying and selling during a specific time frame. So those charts we were looking at, that could have been a daily chart, a weekly chart, or a monthly chart, or a 1-minute chart, 5-minute chart, 10-minute chart. They're all going to look exactly the same. So the doji works on any time frame. All the candlestick signals work on any time frame. Again, they're the cumulative knowledge of everybody buying and selling during a specific time frame. So a lot of people say, well, why use the Dow? Because the Dow is usually a very good indicator of what the big money is doing. The benefit we have is we can see the signal. This is an evening star signal, a big up day, a day of indecision, and the third day closes more than halfway down this candle. And where did it occur? When the stochastics were in the overbought area. When was it time to go short? When you saw the Dow close the next day below the T line. How long do you hold short positions? Until you see a candlestick buy signal. This is a morning star signal. A big down day, a day of indecision, and a close more than halfway up this candle and above the T line. And look where they bounced it, right smack dab off the 200-day moving average. Yes, you can pretty much expect with a high degree, I say again, remember a high degree of probability. Nothing's set in stone. But the reason we're looking at candlesticks today 400 years later is because the Japanese race traders that developed candlesticks, they didn't become wealthy. They became legendarily wealthy. Oh, Roderick, I try not to promise things. The other night I promised my wife, I said, tonight I'm going to make you the happiest woman in the world. And she said, gee, I'm sure going to miss you. So, but the term here to be aware of is the probabilities. The probabilities are extremely strong. The reason we have those probabilities is if they didn't work, we wouldn't be looking at them today. So anytime we see a doji in the oversold area and it trades positive, the probabilities are extremely strong. You're going to move higher. You see a doji shooting star and it opens lower the next day with stochastics in the overbought area, they're probably going to come back to a support level. Again, there's another morning star signal. So remember, prices move the same way time after time based upon human nature. And all the Japanese race traders did for us was not only illustrate what those signals were, but they also would explain what the investor psychology was that created those signals. And when you have that combination, you've got the same analysis factors that somebody that's been trading in the market for 50 years. So you're either obviously in an uptrend, a downtrend, or a sideways trend. And we have much more definition, visual recognition of what trend we're in based upon obviously the direction and what type of signals or patterns occur at the tops of a channel or at the bottom of a channel. We also know prices move in waves. Three major lines you are using are the 200-day. Let me go back. Now, the red line is the 200-day moving average. The blue line is the 50-day moving average. And the gray line is the 20-day moving average. These are all simple moving averages. I always get a lot of people asking, well, why don't you use exponential? They're more accurate. We're not using them. We're just watching to see what everybody else is doing at those moving averages, is because those are the moving averages they're using to make their decisions. And then the T line is this little black line. And it's probably in the 40 some odd years that I've been investing, this is probably one of the most accurate indicators of all for analyzing a price move. Is the other line on the chart? There might on some of the charts there might be the little green line, which is the 3 exponential moving average, which becomes much more effective the further away you start moving away from the T line. So again, the T line, the 8 exponential moving average. That very simple rule. If it closes above the T line, a candlestick buy signal, you can stay long until you see a candlestick sell signal and a close below the T line. So that helps us. I saw, there was somebody advertising a while back that you can make a fortune trading trend channels. And I'm thinking, oh, yeah, you can make a fortune, but they're not that difficult. We can analyze a market analysis of where our sell signal is, where our buy signals are. And this one we call a McMuffin. A morning star signal is a big down day, an indecision day, and then the third day closes more than halfway up that dark day. That's called a morning star signal. Then we also have our doji sandwich, which is a big day, a doji, followed by a positive open, and another big day, the same magnitude as that day. That's our doji sandwich. So that becomes your morning sandwich or a McMuffin. Now, the rationale behind a McMuffin signal is that a morning star signal confirmed tells you there's going to be more upside. A doji sandwich tells you there's going to be more upside. And when you combine the two, it's just that much more evidence that you're now going to be in a strong uptrend. Again, we can analyze the trend channels of knowing when to be selling. And anytime we can develop that trend channel, which I think we have, if you can hit 2 points and draw a parallel line from that point, that tells me if I'm drawing this parallel line, I'm looking right about in this range to see what's happening with the candlestick signals, to see what type of signals are occurring here. Again, in the oversold area, and I start to see buy signals, and a close back up above the T line. If I'm short, I can start going long because the probabilities say I'm either coming back up to the 50, and if it goes through the 50, where's my next target? If you extrapolate that top of the channel out, watch to see what's happening up here. So what's happening up here? Well, we have another sell signal, bearish harami, and it opens lower the next day. Where's the next target? Back down to the T line. And what other factor do we have here? We're in the overbought area, and look how far away we've moved from the T line, and we're hitting right on that resistance level. So it just allows us to start closing out positions much faster. And what's the worst case scenario? They back it off and then turn it around and bring it back up through this level. We can always buy it back. But the probabilities say it's time to take profits. Where's our next target if it closes below the T line? You extend this line out and notice what happened down here. A morning star signal right off the 200, starting the next uptrend. Where's our next potential target? Looking to see what happens once it gets back up to the top of the trend channel. And when I say looking to see what happens when it gets back to the top of the trend channel, I want to see whether it's breaking through or whether we get another sell signal and we start taking profits again. So anytime I see a trend channel developing and it starts backing off, where do you think the next target? This is Nugget, the gold index. We're looking to see what happens once it comes back down to the bottom of the trend channel. If it supports here, where do you think our next target's going to be? We're buying right here, looking for it to come back up into this area. Now, when I say buying right here, what happens to most investors, or what's the reaction to most investors if the market or a stock or a commodity has been moving down like this? You've got everybody and their brother, as far as talking heads on the financial news stations, telling you how bad things are, that you should be out of this. And they're still probably saying, be out of this. But what do we see as far as candlestick investors? You can see that somebody is buying down here. So no matter what you hear anybody else say, uh, there's only one thing that is correct, and that's the market. And when we can start analyzing what everybody's doing in the market, that puts us in a position where we're buying when everybody else doesn't want to touch it, and we're selling when everybody else is exuberant. It does two things for us. One, it gets us into positions much faster for the next profitable move. And two, candlestick signals are the graphic depiction of a change of investor sentiment telling you have a high probability there's been a reversal. But you also have the same scenario on the downside. Every major money manager always says, cut your losses short and let your profits run. Well, in the 40 years I've been in the business, I've never heard a single one of them tell you how you cut your losses short and let your profits run. Candlestick signals make it very simple. If I'm buying right here and this was a signal that told me the bulls were in control, Japanese rice traders have a very simple rule. If it closes more than halfway down that candle that told you the bulls are in control, close it out. That means the bears are still in control. So I tell people, you don't have to analyze, you don't have to be a sophisticated technical analyst. All you really have to do is be able to see what signals are occurring. And it's kind of like the old couple that are getting ready for bed, and she's standing there naked in front of the mirror, and she said, look at me, my face is wrinkly, my arms are thin, my butt's skinny, my legs are spindly. She turns around to her husband and says, is there anything you can say about my body that would make me feel good? He goes, well, your eyesight's still pretty good. So all you have to really know how to do is see, because notice what's happening here. In the oversold area, we're getting a lot of dojis. And what does dojis represent? Indecision. And usually where is indecision going to occur? Usually at the end of a price move. So we have the benefit of seeing what happens at support and resistance, so we can analyze much more accurately when a breakout is about to occur. Again, notice our bullish engulfing signal in the middle of this wedge. What did that tell us about this wedge? They weren't taking it back down to the bottom. The bulls have stepped back in. And where did they do it? Right smack dab off the 50. What did that tell us about the upside? That now there's much more probability they're going to break out of that channel. Anytime we can see a wedge formation and then they break through major moving averages, that tells you there's been a drastic change of investor sentiment. It's time to get into that position. The Dow trading indecisively. And then this is what we call, again, our best friend signal, a little doji gap up in the oversold area. What that tell us about investor sentiment? There's been a drastic change. That puts us into positions much quicker than other technical indicators. Just being able to use the candlestick signals and the patterns allows us to analyze what's happening, especially at resistance and support levels. When they start gapping up through a resistance level, coming off, there's again our bullish engulfing signal, tells us we want to be buying, that there's a new investor sentiment. Again, a trend channel, bullish signals, and then notice where our best friend signal occurred. A doji gap up through this level. What that tell us immediately? That there's a new dimension in our investor sentiment. That's probably going to be a very strong price move. Works just as well on the downside. Anytime we can see sell signals and a gap down, that tells you there's going to be a strong force to the downside. Or notice, again, if we were buying right here, what would be our analysis? You're going to see what happens when it gets to the 50. Notice what happened when it got to the 50. A little shooting star, hanging man, doji, hanging man, bearish engulfing signal. What'd that tell us here? That we're getting a lot of sell signals finally confirmed. What was that telling us about our trend? We're heading back down again. So candlestick signals are the graphic depiction of the most consistent investor sentiment or most consistent indicator in the world. And that's human emotions. If you always kind of analyze that prices don't move based upon fundamentals, prices move based upon the perception of fundamentals. That's all candlestick analysis is analyzing when there's been a dramatic change of investor sentiment. And this puts us in big price moves. Now, is every price move we analyze going to be a big price move? Definitely not. But it puts you in situations where the probabilities of being in a big price move are that much more greater. So when we're searching for signals and patterns, we're looking for that fry pan bottom and where it's going to be breaking out. If it gapped up, again, there's our best friend breakout, we're buying right here because that gives us the ultimate timing that if we know this is a pattern breakout, what do we expect coming out of a fry pan bottom? Big, strong price move. Or a J-hook pattern. Even if we miss this move and we saw this happening, we can be buying right here because we know what the next wave of this pattern will be. Wave 1 and wave 3 are going to be pretty much the same. The best friend signal. A lot of people say, I don't want to buy a stock that's already up 3, 5, 10, 15, 20, 40%. You do if it's illustrating or demonstrating a pattern. So a lot of people say, well, aren't you afraid that it's going to open up and head right back down? Yeah, that can happen. But I would guess for every time that happens, you're going to get 10 times where you get a big, huge price move. This is what we're looking for. This is the strongest of all the candlestick signals, is the kicker signal. Notice how it opened and traded lower on that day, creating a dark candle. The next day, they gapped it up above the previous day's open and went the opposite direction, or the investor sentiment was essentially kicked in that direction for a much, much stronger move to the upside. So this is where you want to use your common sense analysis. There's our bullish harami. which tells us the selling has stopped. And where did it occur? Right smack dab on the 50-day moving average with stochastics in the oversold area. So if you see that, what's your trading strategy the next day? If it opens positive, the probabilities is that it's heading up. If it gaps up, the probability is not only is it going to head up, but it's going to be a strong uptrend. So if you're trying to figure out where to buy, if you see that setup, we were buying calls immediately as soon as we saw that this was going to open positive the next day after our bullish Harami right on the 50, so we can catch that next move. It provides not only the time to be in a position, but it also demonstrates which positions are going to be acting the strongest. So if the market is heading up, all boats are going to be rising in a rising tide. We have the ability to find which boats are going to rise a lot faster in that rising tide. Notice where this chart did a fry pan bottom gap up right off the 50-day moving average, telling us we got a much bigger probability that not only we're going to be heading up, but usually with a very strong price move. This is vary from today. Notice mid last week, we did a left-right combo. Again, one of our strongest reversal signals. And where did it occur? Right smack dab off the 50. What did it do today? It closed above the T-line. We were recommending this in the chat room today because it was moving positive, confirming this indicator or this signal in the oversold area. And there's two factors why we were buying. One, because it's a very good chart. And two, it moved up about 10% today. And if it moved from here to here, back up to the recent highs, that's about a 90% upside potential. So not only do we have the benefit of graphically seeing which stocks have an upside potential, but we can see what's happened at other levels to tell us, all right, this is not going to be a 4% move. This might be a 90% move. Obviously, those are going to be the stocks that we go after. Gaps, same scenario. You can see how indecisively it was trading right here at the 50 with stochastics in the oversold area. And today it closed above the T line. Would definitely be a buyer of this one because essentially we'll have a wave 1, wave 2, going into wave 3 with a high degree of probability. We were buying chem because of the doji gap up through the T line, off the 50 from the oversold area. We're starting to take profits today because we're starting to see dojis, hammers, and now it closed below the T line. Again, we're not trying to sell at the absolute top. We're not trying to buy the absolute bottom. We want to get this move with a high degree of probability because the compounding effect is going to be huge compared to trying to find the tops and the bottoms. So anyways, we got the Candlestick Forum website, which consists of, we have a chat room, both for option traders as well as stock traders. We've got about 150 people to 200 people in there every day. And it's a perfect place that if you're learning candlesticks, you can ask questions, number one. And number two, yes, we trade futures over in the options room. We closed out our hog positions today because of a bearish engulfing signal. And we closed out our wheat short because it was trading positive today, doing a bullish engulfing signal. It's, I think we've got stuff on here. So again, I put out 2 or 3 stock picks every day. Let's see if I've got that here. We've got the chat rooms. I put out 2 or 3 stock picks every day. Every Monday night and Thursday night, we do trainings just like this. We can analyze which sectors or which stocks are working the best in the markets. And then we also have weekly trainings where we've got the training videos that members can buy at a discount in our area, like how to scan for the best stocks, where to set your stop losses, your entry and exit strategies, everything that applies to common sense built into candlesticks that you don't have to buy the training. We do it live. So I put out a 2 or 3 stock picks every day. not so that people have stock picks, but we do it in a video format so that as you're looking at it, you're understanding why those picks are being made. We've discovered that if you just give people picks and they don't know why, it doesn't do them any good. It's like teaching the fish. It's like the cop that was standing on the street corner. And he saw this drunk weaving down the street, blows his whistle, pulls a guy over. As he walks up to the car, he looks in the back seat, and there's a penguin sitting there. He goes, "What the heck are you doing with a penguin in your back seat?" The drunk said, "Oh, I found him out on the street, and I don't know what to do with him." And the cop said, "Well, take him to the zoo." The drunk said, "Oh, that's a good idea. I didn't think of that." Well, the next day, the cop's standing there on the street corner, and here comes this drunk weaving down the street again, blows his whistle, pulls the guy over, walks up to the window, and there's a penguin sitting in the back seat. He goes, "I thought I told you to take the penguin to the zoo." Drunk said, "I did. He liked it so much today we're going to a baseball game." So if you don't understand why you're doing something that doesn't do you any good, um, so our website is for training people. We've got probably about 25, at least 25% of our members use TradeStation. So even if you have questions about TradeStation, that's a good place to go in and say, "How do I put this on my charts?" Or uh, the it's a good place not only to ask questions about candlesticks and get stock picks there, because we got plenty of people that have been around for years that know how to analyze which charts are the best. So it's if somebody comes up with XYZ, you can go to XYZ chart and see why they're recommending it. So um, I think Pat has provided a. We've got a video just so people can get acclimated to uh, candlesticks. It's a 56-minute video. Oh boy, and I got to figure out where the link is. I think this is the link. It's a 56-minute video. We usually, I think, sell for about $147. Pat, my marketing person, is putting it out on. Oh, that's the link to it for $17. So people always ask, "Well, why do you put your stuff out so cheap?" Because I discovered through the years that everybody knows about candlesticks, they just don't know how to use it. So if you start analyzing or start looking at the common sense that's built into candlestick signals, it makes your investment perspectives that much strong, that much stronger. Basically, if you understand why prices move, now you've got the visual and mental concept of trading successfully and not letting your emotions control your trading. Are you going to? Yes, I go slower in the video. Yes, I had to go through pretty quick because we probably had three training sessions here, and I wanted to keep it less than an hour so you didn't all fall asleep. But I tell people you don't have to overanalyze candlesticks. It's just common sense put into a graphic depiction. And it's kind of like the lady that walks into the vet with her parakeet, lays it down on the table, and she said, "Can you fix my parakeet? He's been my best friend for years, and there's something wrong with him." And the vet looks at it and said, "Ma'am, I think your parakeet's dead." She goes, "Oh no. Are you sure? Isn't there something? He's been my best friend. Isn't there something to make sure?" And he goes, "All right." So he goes out to the back of his clinic, brings in a cat, sets the cat next to the parakeet on the table. The cat sniffs it, kind of looks up at the vet, shakes his head, and he goes, "Ma'am, I'm sorry, but your parakeet's dead." She goes, "Oh no. Are you sure? Isn't there something you can do? I mean, he's been my best friend." He goes, "All right." Goes out to the back of his uh, laboratory again, brings in a great big uh, Labrador retriever. He's bounding in, puts its paws up on the table, sniffs the bird, looks up at the vet and kind of shakes his head and says, "Ma'am, I'm sorry, your parakeet's dead." He goes, "Oh no." So they go out to the front desk. And he goes, "Well, that'll be $250. She goes, "You're charging me $250 just to tell me my parakeet's dead?" He goes, "No, ma'am, I would have done that for $18, but then he wanted a CAT scan and a lab report after that." So you don't have to overanalyze candlesticks. It's all common sense put into a graphic depiction. from your experience. So with that, I'll take questions. Um, from your experience, does Candlestick apply to 30-year bonds as well? Yes. Anything that has fear and greed, stocks, bonds, futures, uh, currencies, tulip bulbs, anything that has fear and greed in it, that's what candlesticks are. They are the graphic depiction of human nature of that trading entity, no matter what the trading entity is. Remember, the Japanese rice traders made legendary fortunes on the most basic of all commodities, rice. Oh, Gustavo, yeah, it should work. Anything that you can pull up on a chart, you can do it on a 1 minute, 5 minute, 10 minute, half hour, 30 minute, hourly, daily, monthly, weekly, anything, any time frame for any trading entity. I used to trade the E-minis off the 1 minute, 3 minute, 10 minute chart combination. Right now, during the middle part of the day, I'll trade soybeans or the dollar or crude oil off the 10 minute chart. And if the 10 minute chart is setting up well, then I'll flip down to my 5 minute and my 1 minute as far as entering the trade. I include volume, Edgar, in my trading universe, meaning I don't want to trade stocks that are trading below $5 because most brokerage firms will not margin a stock below $5. And I know that every time I put on a trade, the probabilities are in my favor. So I want to get as much leverage as possible. And I usually make my minimum where I want the stock to be trading on average 200,000 shares a day. Because if I make a decision to get in and get out, I don't want to have to sit there for 3, 5, 10, 15, 20, 40 minutes trying to get my execution filled. I want to have it filled and then analyze what the price is doing after that. Now, there are some people that say, well, I want to see the volume go up as the price goes up. Volume and price have absolutely nothing to do with each other. If nobody's willing to sell you the stock and everybody's willing to buy, that price is going to go up on smaller volume. So we're buying price, we're not buying volume. Do you notice head and shoulders patterns? Uh, Mike, you can. Now, the number one criteria for anything I do is the candlestick signal itself. Then everything else becomes a confirming indicator. Is it trading far away from the T line? Is it closing above the T line? Is it bouncing off a moving average? Is it going through a trend line? Is it where can it go to? I'll throw the Fibonacci numbers on. I'm not trading the Fibonacci numbers. I'm looking for what the targets might be. That when it gets there, if I see a sell signal, I know what level they're starting to take profits. As far as any other pattern, head and shoulders, yeah, they become a side issue. What I'm looking for is what's happening in the trend right now. Where is it as far as above or below the T line, and what are the candlestick signals telling me? When I was a stockbroker, I can proudly say I was probably one of the worst investors in the world because I was the one that was panic selling at the bottom. I was the one exuberantly buying at the top. When candlesticks came along, and the common sense was that most people sell at the bottom, and a lot of people say, well, where do you grab for the fallen knife? The candlestick signals were now telling me where was the smart money buying and where was the smart money selling. All right, so with that, any other questions? Yeah, as I say, for 3 cups of Starbucks coffee, for the moving averages, you're going to get a heck of a lot more information. That's kind of our modus operandi, is to give people a trading platform to trade. To me, it's the most successful. If you've got a trading program that you're using, if you overlay candlesticks on top of it, it's going to make it that much more clear to see what's going on. If I am only going to learn thing to go with candlesticks do you recommend? Yes, the T line. I made good money before the T line was introduced to me. I make great profits each month using the T line. Edgar, no. I would say that probably 90% of all investing out in the world and 100% of the institutions use their fundamental analysis. So that leaves about 10% of all trades are done on the technical basis. And candlesticks have been around for hundreds of years, introduced to the United States 30 years ago, 40 years ago when I first started learning it. And it was not because it was being kept secret, just that nobody ever paid attention to them. So when they started getting introduced to the United States back in the late 80s, when I started looking at it, it was just common sense. So right now, I would guesstimate. A lot of people say, well, if everybody's using a technique, isn't it going to be kind of washed out? I would guess right now that probably 1/10 of 1/10 of 1/10 of 1% of the people in the world use candlesticks. Yeah, if you're Roderick, we have Tuesday night training sessions right now where we take each of the 12 major signals and go through that signal uh, in detail. I think 2 weekends from now, we've got a 2-day training that takes you through all the basics of candlestick signals, which are your bricks and mortar, your ABCs, and then through all the high profit patterns. Then we show people how to scan for the best signals, where to set your stop losses, how to take profits. I mean, everything that's built into candlesticks is just common sense. Um, so we're not teaching people any great secrets. This stuff's been around for hundreds of years. We're just showing people how to use them correctly. Yes, yes, definitely. That's why we're here. That TradeStation has very good candlestick charts, um, and again, you can put whatever indicators you want. First indicator, first three indicators I'd put on is the 200, the 50, and the 20, and then I would definitely have the 8 exponential. We've got videos on the T line. Yeah, I'd say I don't know if that's still a $17 course, but it's on uh, it's on our website uh, in the products and services area. Can you mention the quote or forum? Oh, the cost. The cost. Uh, our normal cost is $97 a month, and again, that includes 2 or 3 stock picks a day, the chat rooms, the Monday night and Thursday night training sessions, and then usually an additional training session during the week, and then uh, oh, all everything's at a drastic discount for members. I've written 3 books on candlesticks. Those are all available. They're available at on Amazon, but some of the books are still selling for like $97. They're $57 on our site. Uh, so you usually set profit targets. You set profit targets in the sense that if I'm buying XYZ and it looks like wave 3 could take me up to the next resistance level, the 200-day moving average, that becomes my target for anticipating getting into the position in the first place. But after that, the important factor is I stay long as I don't see a sell signal. All right. Well, thank you for sitting through all this. Um, I guess the one important factor of, again, candlesticks in itself is extremely high probability and successful. And if you're already trading a successful trading program, overlay candlesticks on top of your charts and it'll make it that much more concise and clear. All right, Don, thank you for having me today.